So hello everyone, and I want to pick up here on chapter 2 with regard to something called the enterprise value of a company. Okay, and the enterprise value of a company is, as stated here, or as stated here, this is the total market value of a firm's equity and debt, less the value of its cash and marketable securities. So the best way to interpret it, well, here's the equation, which is quite simple. You take the market value of the equity plus the debt that's being currently incurred, and you subtract off the cash. And the best way to interpret it is, as this one line says here, the cost to take over the business, what it would cost, okay, to take over the business. So here's the net cost, and there's still a $21.2 million in cash. So it would cost to buy all of Global's equity and pay off its debts, but because we would acquire Global's $21.2 million in cash, the net cost of the business is only $145.9 million. So this is an important term, and it's called the enterprise value. Okay? So again, here's the equation for that. It's quite simple. All right, so let's look at the income statement. So the income statement is a list of the firm's revenues and expenses over a period of time, and this is normally done quarterly and one at the end of the year. All right. So you get the revenue. The very, very top of the income statement is the firm's revenue. Okay, that's the very top. I'll talk about that, right? The last or bottom line is the net income, and that determines its profitability, right? So this is sometimes, again, it's looked at as a profit loss statement. And remember, words are interchangeable, so net income is also called earnings, okay? So you don't get confused. So the income statement is going to show the flow of revenues and expenses generated by those assets, okay, and liabilities. All right, so here is a pretty simple income statement. And again, here's the revenues or total sales. Revenue and total sales are the same. And here's what it costs to make, the cost of goods sold to make this product, right, to make the product. And when you subtract those, you get the gross profit. You'll notice this is negative, obviously, so the parentheses is there. So here's your administrative expenses and your research and development. So we start subtracting. We start subtracting things off of here now, as you can see. We have expenses, right? We're starting to subtract expenses. And one of them, of course, is depreciation. All right? And when we subtract that off, we're left with operating income, as it's called here, right? And basically, if there's no other income, this drops down and becomes what's called EBIT, our earnings before interest and taxes. And here is our interest income. This interest income is the interest we have to pay on the debt, on the bonds. But it's great because we get to write that off. So that's important. You notice how this gets written off? Okay. So we're left with pre-tax income of 2.7. Notice how it lowers our tax base. Everyone see that? So our taxes are only 0.7 million here, right? On 2.7 million. And so here's our net income or earnings, $2 million. Okay? So that's that. All right, so again, the gross profit, and as I just mentioned, lists the revenues from sale of products and the costs incurred to make and sell the products. Said here, the gross profit is the difference between the sales and the costs. So the third line of an income statement that represents the difference between a firm's sales of revenue and its cost. All right, and then we have our operating expenses here, as I mentioned, right, which are right here. Here's our operating expenses. Okay, and then here's EBIT. All right, so then we have our net income, and we have our earnings per share, which again is our net income over the number of shares outstanding. So this is an important, little equation. It's a ratio, right, to know. And I deal with this all the time when I have to look at my stock annual reports, and I see what their earnings per share was and how much they're given in dividends to the shareholders. Now there's a term here called diluted earnings per share. Sometimes there's stock options, and basically the holder of the options will have the right to buy more shares, and if those things are exercised, the number of shares go up, which is going to dilute, right? This will go up higher, and that'll dilute the earnings per share. So that's called diluted earnings per share. A firm's disclosure of its potential for dilution from options it has awarded, which shows the earnings per share the company would have if the stock options were exercised. Okay? So there's earnings per share and diluted earnings per share. So here's an example of diluted earnings per share. You'll notice here it was 3.6 million, and then I picked up, here's an extra shares that was sold, right, of restricted stock, so that you added 200,000 shares, and that diluted this went from 5.556 earnings per share down to 0.526 earnings per share. Okay, so I just wanted to say that. So now here in section 2.4 we have probably the most important statement of all, and this is called the statement of cash flows. So let's talk about the statement of cash flows for a minute. The statement of cash flows basically tells you how much cash you have on hand. Okay, so think about it this way: you can have a lot of assets, okay, and stocks and all kinds of things, but if you don't have cash to pay your bills, if you do your own personal statements and you can't pay your bills because you have no cash, that's a problem. Okay. So this is a measure of the firm's profit over a given time period, only in the sense that it tells you your cash that you're able to collect, whereas the income statement includes stuff that you can't feel or touch cash-wise. The statement of cash flows is telling you that this is your statement of cash on hand, short term. There are two reasons that net income does not correspond to cash. First, there are non-cash entries on the income statement, such as depreciation, right? And here it is right here. Second, certain uses of cash, such as the purchase of a building, are not reported on the income statement, all right? So the statement of cash flows looks at all the information from the income statement and balance sheet to determine how much cash you have generated and how that cash has been allocated, okay? And there's going to be 3 line items. So just to make everybody clear, there's going to be 3 line items on the statement of cash flows. And here it is right here, 3 sections, I should say, right? Not 3 line items. Sorry about that. 3 sections. Operating activities, investment activities, and financing activities, okay? So those are important. So operating starts with net income from the income statement, and then it'll adjust this number by adding back all non-cash entries related to the firm's operating activities. The next section, investment activity, lists the cash used for investments, and the third section shows the flow of cash between the firm and its investors. All right, so in our example here, global conglomerate statement of cash flows is shown below here. All right, now, just to show everybody, well, I don't know if it's going to let me highlight, but no, it won't. But here's the operating activities, okay, and they go through the math here. So here's the cash from operating activities after all is said and done. Notice how they put the depreciation back on after you wrote it off. That's positive. Everyone see that? And there's a couple negative things here, right, that are in parentheses. All right, and then here's the cash from, here's your investment activities right here. Maybe you invested in securities from other companies. So here's your cash from investment activities. Notice again, you're negative here and you're negative here, right? So things aren't going too well. And here's your financing activities. Financing activities means the stocks and bonds. So here's the dividends paid, right? If you pay dividends, that's negative, right? So here's cash from financing activities. That's positive. You see that? This is positive. This is negative. This is negative. So your overall total, the addition of 1, 2, 3 is positive. Okay? So again, they look at, and here's a description of each thing, okay? And they tell you what accounts receivable are. Accounts receivable are what people owe you and haven't paid you yet, right? And I believe we talked about that. So when a sale is recorded, but the cash has not yet been received, as we said, we must adjust the cash flows by deducting the increases in accounts receivable, because you obviously physically don't have the money yet, right? All right, accounts payable are what you owe the vendor, but that's positive because that's money that you haven't paid that you still have. Obviously, you could default on your debts, right? So that we add increases in accounts payable. So that's really your cash available to the company because technically you don't have to pay your bills, right? And then here's inventory. So increases in inventory. Basically you had to pay for them, right? So here's inventory. You notice how this is increased. We increased our inventory. So that's negative, right? Right. So this is a cash expense, right, as they said. And then we deduct anything else, okay? So they go through the math here a little bit, and it's instructive to go through this whole problem, this global equity. All right, and then here's your investment activity. And finally, your financing activity. So basically, the difference between, now, I had mentioned to you that other places have a statement of retained earnings, right? So the difference between a firm's net income and the amount it spends on dividends is referred to as the retained earnings for that year. So in your book, they don't show a statement of retained earnings, which other books do. So I just wanted to make that point here. So here's your retained earnings. All right, so anyway, all right, so I'm going to, I'll stop there, and then I'll pick up on this example here, okay? I'll pick up here. All right, everybody, have a good President's Day.